Then in part C of the required, evaluate the appropriateness of the valuation performed in part B. So look at the valuation that you performed in part B and evaluate the appropriateness of this valuation. So guys, this is actually made up of two parts. First, when we are evaluating the appropriateness of our calculation in part B, we need to discuss whether it's appropriate to use the free cash flow method or not. So should we have performed this valuation of Springfield using the free cash flow method? Is that method appropriate? In addition to that, when performing this calculation, we were calculating the maximum value, which includes all general as well as specific or unique synergy benefits and costs. Is that appropriate? So is it appropriate to use the free cash flow method, and is it appropriate to calculate the maximum value, which includes all general and specific or unique synergies and costs? So that's what we are going to focus on in our discussion. Let's first look at whether it's appropriate to use the free cash flow method to perform the valuation on Springfield. First, guys, very easy, this part of the required. It's important to note that you can only use the free cash flow method if the company is a going concern. So there's nothing to indicate in the question that Springfield is not a going concern. There's everything to indicate that they are a going concern, so it is therefore appropriate to use the free cash flow method. Then in addition to that, it is preferable to use the free cash flow method when you are calculating the value of a controlling interest. So in this question, Healthstone is interested in acquiring 100% of the shares in Springfield. So it's therefore appropriate to use the free cash flow method because we are performing a valuation of a controlling interest. We calculated the value of 100% of the ordinary shares in Springfield. Then in the next 2 points, I'm going to discuss cash flows and the WACC of Springfield. Now guys, remember we said that we used the free cash flow method to perform our valuation because it was possible to estimate the future free cash flows, and we could also calculate the WACC for Springfield. So because that information was available, we could perform the valuation using the free cash flow method. Or because that information was available, it was appropriate for you to perform the calculation using the free cash flow method. So what you could have said, and I was quite lenient over here with my discussion points, so you have a couple of options over here. First, you could have said that because we can reliably forecast the future expected free cash flows, it's appropriate to use the free cash flow method. Or instead of that, what you could have said is the free cash flow method is the most technically sound method because it is forward-looking and it focuses on the cash flows that Springfield is expected to generate in the future. So we look at Springfield's future estimated cash flows, we present value those cash flows to get a value today, and we determine the value based on the present value of the future cash flows. So because we are just present valuing the cash flows that the company is expected to make in the future, that gives us a very good indication of the company's value today. So that's why it's the most technically sound method. So this mark over here, guys, is awarded for discussing the cash flows. So either you can say, based on the information provided in the question, we were able to estimate the future free cash flows, so that's why it's appropriate to use the free cash flow method. Or you could have said this is the most technically sound method because it is forward-looking and it focuses on cash flows that Springfield is expected to generate in the future. Then let's discuss the WACC. So first you could have said, based on the information provided in the question, we were able to calculate the WACC of Springfield. So subjective entity level adjustments were avoided. We didn't calculate the WACC of a similar listed company and then adjust for entity level differences between the two. We calculated the WACC of Springfield. And if you want to perform a valuation using the free cash flow method, you need the company's WACC because we use the WACC as our discount rate when calculating the present value of our free cash flows. So that also makes the use of the free cash flow method appropriate. Now, once again, guys, I was quite lenient here in the solution. So as an alternative, you could have said that Springfield maintains a stable capital structure, allowing for the use of a single discount rate. We were able to calculate a single discount rate. We calculated their weighted average cost of capital, and we used that as our discount rate. All right, so we've discussed why it is appropriate to perform the valuation using the free cash flow method. Now we need to discuss whether it's appropriate to include the value of all general and specific or unique synergy benefits and costs in our calculation. So in other words, is it appropriate that we've calculated a maximum value? So because we calculated the maximum value, all expected synergies and costs were incorporated in our calculation. However, it's important to note that other market participants would only be willing to pay the fair market value. They wouldn't be willing to pay the maximum value because, remember, the maximum value includes unique or specific synergies that would only exist between Healthstone and Springfield. Now, the other market participants don't know about those specific or unique synergy benefits or costs. So when calculating a fair market value, we only include general synergies in our calculation, meaning we only include synergy benefits that all market participants are aware of in our calculation. So it's important to note, if Healthstone wants to buy 100% of the shares in Springfield, they shouldn't pay the maximum value because they'll probably then overpay. Because it's important to note that other market participants or other bidders, so there might be other companies also interested in buying Springfield's shares, but those companies won't be aware of the specific or the unique synergy benefits that exist between Healthstone and Springfield. They are only aware of general synergies. So the maximum that those other bidders would be prepared to pay is the fair market value. They would not pay the maximum value because they don't know about those specific or unique synergy benefits. In addition to that, synergy benefits are not guaranteed. The expected synergies might not actually realize, so they might not materialize. And if they don't materialize, then Healthstone would have overpaid for the acquisition. It's important to note that even if these expected synergies do realize, Healthstone should never pay the maximum value, because by paying the maximum value, then the full synergy benefit is paid to the shareholders of Springfield, because they pay that full benefit across to the old shareholders of Springfield. They don't keep any of the money in the new company. So because Healthstone will contribute to these synergy benefits or these expected savings, they should at least be shared. They shouldn't just pay the maximum price and give the full value of those synergy benefits to the previous shareholders of Springfield. They should at least share those synergy benefits. All right. So that answers part C of the required. Then in part D of the required, in recent years, there's been a significant drop in the number of mergers and acquisitions in South Africa. You need to list some of the possible reasons why international investors may be reluctant to invest in South Africa. All right, guys, and this is for 4 marks. Now, you need to have an awareness of what's going on in the world around you. So what are some of the things going on in South Africa at the moment that would cause international investors to be reluctant to invest in South Africa? First, as long as you discussed any issues that we are experiencing in the public sector, you can award yourself a mark. So if you discussed anything along the lines of state capture, bribery, or corruption in the public sector, give yourself a mark. Obviously, we are not only experiencing problems in the public sector, but also the private sector. So I've given Steinhoff here as an example. You don't have to give an example. As long as you speak about governance issues that we are experiencing in the private sector, you can award yourself a mark. Then in addition to that, investors might be concerned about recent credit rating downgrades or the threat of another credit rating downgrade. If you discussed land reform or anything to do with the uncertainty regarding land rights, you can give yourself another mark. If you discussed load shedding or the current electricity crisis, you can give yourself another mark.
Then there's one mark available over here for discussing any other valid point. So if you have any other valid point that you've discussed, please award yourself that mark.
All right, guys, that then brings us to the end of this question. If there's anything that you're still struggling with, please let me know. Thank you.